Hi, this is Matthew Cratter from Trader University, and today I want to talk about black swans and the stock market crash of 2020. If you're worried that this is a bear market or just want to see what I'm trading in this environment, be sure to hit that subscribe button. And also be sure to stay till the end of this video when I'm going to talk about how long I think this bear market is going to last. So, Black Swan, for those of you who don't know, comes from this famous book by Nassim Nicholas Taleb. Basically, a black swan is a rare or unpredictable outlier event. Now, the coronavirus is definitely a black swan. It's not something that I could have predicted, but you can predict stock market crashes using various indicators. And those of you who have been following me know that I paid a lot of attention to the yield curve inversion that happened in August of last year. This is when the long-term treasury rates trade below the short-term treasury rates. And this has been a very good forward-looking indicator of stock market crashes and recessions. So I did a bunch of videos late last year, 5 signs of a coming bear market, the 2020 recession and bear market, are you ready? You can find all these on my YouTube channel. 4 ways to protect yourself from a stock market crash. Well, where are we now? We're at the point now where it does not even matter how bad the coronavirus is as a health threat. Maybe we come out with a vaccine very, very soon. Maybe the mortality rates are lower than are being calculated. But the problem is everyone has already moved and positioned themselves as if this is going to be a recession. And this has the effect of ensuring that a recession happens. Now, a great version of this is Sequoia Capital, a great VC firm, venture capital firm in Silicon Valley. Back in 2008, right before the beginning of the great financial crisis, they came out with a paper saying basically the good times are over, and they're trying to prepare their portfolio companies, the companies they're invested in, for a recession. Well, yesterday they came out with one for 2020. Entitled The Coronavirus Black Swan of 2020. I'm going to link it in the notes below. It's definitely worth reading. But what they are basically saying is that telling their founders, their CEOs, their portfolio companies, is that they need to prepare for a recession. And they need to prepare for a big drop in business activity, big supply chain disruptions, canceling of travel, and slowing sales in all their companies. And so the question is, and these questions might be applied to the individual as well, do you have a cash runway? If things really slow down, if you can't work, if your company goes under, if you get laid off, do you have 3 to 6 to 12 months of cash saved up? Are you prepared for slowdown in the business you own or the business you work for? Are you prepared for food shortages? These kind of things. Now, this is a great example of what George Soros calls reflexivity, which I think is a very good model for how the markets work and how black swans affect markets. So basically, you have this cycle here. You have perception, you have fundamentals, and you have price. Now, this can work. You can start anywhere on the circle, but where we are now is we've had some fundamentals with the virus, but the perception is that things are really bad and people are panicking, businesses are acting as if there's going to be a recession. And the problem with this, as we've said, is this becomes a self-fulfilling prophecy. When people prepare for a recession, it causes a recession. When people stop traveling, the hotels and airlines hurt, the cruise ships hurt. When you have fewer business meetings, sales usually suffer. Everyone just puts everything on hold and is just glued to the Twitter newsfeed or the CNN newsfeed. And so this perception causes stock prices to crash, as we've seen. We've had just a really big pullback since the beginning of the year. And when this happens, it affects the fundamentals themselves. And so just the perception that there's going to be a recession can create a recession. And I think the fact that Sequoia has come out with this newsletter, these are some of the smartest people on the planet. They're basically saying it's here, the recession is here, the bear market is here. And so I would urge all of you to take this very, very seriously. Those of you who haven't prepared. If you've been watching my videos, you're probably prepared for this. But if you haven't been, now is the time to prepare for very bad things to happen. Whether the virus itself turns out to be as dangerous as people think it is, it's really hard to say. I'm not a virologist. So how am I trading this? I'm trading this. I'm still long, as we've been talking about. I'm still long the IEF, which is a Treasury bond ETF, 7 to 10 year. You can see just totally spiking to new highs tonight, this morning. TLT is another way of playing it. That's sort of longer dated treasuries. This will move even more bang for your buck. You can see this is unbelievable for something like this, for a Treasury bond ETF, the most conservative kind of low vol investment you can have, to be up 6%. Now you can see yields are falling off a cliff, and this is why bond prices and yields move inversely. So I'm long. I'm still long. I'm actually long the Treasury, the futures version of this, which is TY, TY or TN. They're basically the same, but futures is not recommended for everyone. Easy way to play it is with the ETF here. I'm also long gold, GLD, and I'm long Bitcoin as well, which is still the best performing asset of 2020, holding really well here. It's definitely off the highs, but with the May halving coming, I think Bitcoin just has a very, very long runway. And this is the kind of gold and Bitcoin are the kind of things you want to be in when there are black swans and when the whole system is at risk, which it is now. We've basically, most of the developed world has put all their manufacturing in China, and people are beginning to realize that maybe this wasn't a good idea. And so we could see some really big changes and big realignments as well. So a lot of you have been talking to me. Maybe you're looking to buy crude oil, looking to try to catch the bottom in stocks. I'm not offering investment advice here. This is just my 2 cents and what I'm doing. I don't think one should try to catch a bottom in this. I think we're going to have a multi-month, possibly multi-year bear market. And one way we can think about this is if we look back at previous bear markets. So we can look at the Great Financial Crisis. The stock market peaked in October of 2007, and then it bottomed in March of 2009. So that was basically 1 year and call it 5 months from the peak all the way to the point at which you weren't catching a falling knife. Obviously, there are places you could buy, you could tactically swing trade, but then the market continued to roll over. So that was more than a year, almost a year and a half. And if we go back and look at the previous bear market, which I remember both of these very well because I was trading then. September 2000 was basically you can call it August or September 2000 was the peak. The tech stocks actually peaked in March of 2000, and then we sold off all the way until October 2002. So almost call it a little more than 2 years actually. And so here we have the most recent highs on the S&P were reached in February. And so using this metric, one shouldn't even think about buying until, call it, so a year from now, a year from February would be February 2021. Add another 5 months, and that would put you in about July 2021. So I don't think there's any rush here. If you're a long-term investor, I certainly not trying to panic you. These drawdowns happen. If you've got a 5, 10, 20-year time horizon, you probably shouldn't be selling. You should, of course, consult with a financial advisor about these things. But if you're looking to nibble, if you're looking to buy crude oil or sort of economy-sensitive stocks like Carnival Cruises, the airlines like Southwest, these are stocks, or even oil companies. ExxonMobil's been a disaster, which I've warned people about. It's the most dangerous dividend stock out there. I wouldn't be buying these things unless you have a regular program of monthly cost averaging. But I think there's no rush here. I think the places to be are cash, gold, treasuries, and Bitcoin. These are very advanced markets, very dangerous markets. if you're going to trade them, even trading them from the short side can be very dangerous, because as we've seen the last few days, in a bear market, the short covering rallies, so what we got from February 28th through March 4th, are extremely violent. You can have 10% moves, even more, and then the market rolls back over. So this kind of volatility is quite difficult to trade, and I would be very careful out there. So hope you guys are all prepared, staying healthy, staying safe. Hit that subscribe button and that like button if you found this video helpful, and let me know your thoughts on what's happening now in the comments below. Thanks a lot for listening, and I'll see you in the next video.